Turning now to the battle for Paramount, the entertainment giant soaring as much as 17% today on the news that the board will enter exclusive merger talks with media company Skydance. That after Apollo Global offered $26 billion in cash for the entire company over the weekend. For more, let's bring in Lightshed Partners' Rich Greenfield. Rich, great to have you with us.
This is wild, Melissa. This is really wild.
Why?
Well, because there supposedly is a $26 billion bid. You would presume that would be an all-cash bid for the company. Yet, if it was a cash bid, why was it turned down in favor of essentially a merger of Skydance into Paramount? It doesn't make a lot of sense because if you're thinking about this from a Paramount shareholder standpoint, remember, what happened to Paramount this morning? If you go back, if you pull up the chart and you look at Paramount, the stock was down this morning because shareholders were looking at a transaction that actually was immediately good for Shari Redstone and the National Amusements owners because it was going to take them out. But then it was actually going to dilute Paramount by including Skydance or merging Skydance into Paramount. And so the stock was actually down on that transaction, the sort of exclusive negotiating decision that they made, the stock was down. Then the stock soared on a bid that wasn't accepted, assuming it was real and fully financed, that they excluded that bid. And so everyone's just trying to understand. Investors are sort of baffled. How could you say no to a cash bid and pursue this alternative transaction for the next 30 days? Something doesn't add up. It just doesn't make sense to me or to any of the investors I'm talking to.
What is your intuition? I mean, you've been following the company for a long time. What do you think is going on, you know, behind the scenes, and in particular with National Amusement and Shari Redstone?
Look, there's no doubt that National Amusements made it pretty clear, the Redstone family made it pretty clear that they want out. Like, they want to monetize their stake. I think they see the challenges facing the media universe, and they're certainly looking for the best option. It's surprising that if this Apollo bid was real, it's surprising they didn't take it. I can't really give you a good answer of why you would say no, unless it isn't as, again, it wasn't, we don't have the, what were they paying per share? All we have is this sort of $26 billion enterprise that was in the Wall Street Journal earlier today. Maybe there's more to this than meets the eye. I don't know. Obviously, there's regulatory approval you would need because Apollo obviously already owns TV stations. Not that I think it's a huge problem, but you would need FCC approval for that transaction. I don't think the Skydance merger would have any issues whatsoever from a regulatory standpoint.
Hey, Rich, it's Tim. So help us understand the sum of the parts of this. And because I think it also feeds into other plays within media right now. Now, we all know in media, some of the parts doesn't add up to what the holding company is worth. Time Warner, one of the great examples of just destroyed value. But Apollo started with an $11 billion bid for just TV and studio. So that gives you some baseline. And yet the stock, in terms of market cap, at the end of that day and even for a week following, traded around $8.5 billion. So what should this tell investors who are looking at media assets, understand that private equity is looking at media assets, and understanding that there could be some, some come to value moment here for some of this stuff?
Well, Tim, I got to correct you, just to be clear. It was when you say $11 billion, that was for the studio. But remember, Paramount, while its market cap was $8 billion, its enterprise value was $20 billion. It's got $13 billion of debt. And so that was, they were only buying a piece of Paramount. And so it makes sense why the stock didn't react strongly on that just acquisition of the studio. Obviously, there's taxes to pay. And then you're left with sort of a, very challenged TV business if you sell off the sort of the crown jewel, which is not just the film studio, but selling the TV studio. That is really a valuable asset that was being sold in that transaction. So I can understand, if I'm sitting in National Amusement's shoes, I could understand why I don't want to sell the studio. First of all, it doesn't get me cash. It just gets the company in better position, but it doesn't cash out National Amusements. The shift from buying just a piece of the company, assuming this $26 billion bid is real, that's where that's where the real head scratcher comes in, is like, how could you say no to that? If that offer came in over the weekend, why would that not be more attractive than pursuing a pretty complicated transaction that's probably going to end up with a lot of litigation because you're basically only taking out for cash one shareholder?